Hello, and welcome to Quantum Advisory's investment vodcast for Q3 of 2022. In this presentation, we'll provide a brief market summary, discuss the economic developments which occurred over the quarter, and provide an outlook of what's to come, considering some of the possible short and medium-term outcomes. Firstly, I'll provide a quick summary of the investment market over the third quarter of 2022. As this slide shows, the third quarter of 2022 brought another period of negative returns. Concerns surrounding the persistent level of inflation and the global economic slowdown continue to dominate, as fears of a stagflationary recession rose. During this period, central banks continued their hawkish tones, while acknowledging that the global economic outlook was weakening. In addition to this, governments attempted to provide fiscal support over the quarter in order to combat the rising cost of living. Cash was the only positive performing asset class under consideration. Brent crude oil, which produced a positive return in Q2, fell during the quarter. This was due to expectations of global demand falling as a result of the global economic slowdown. Moving on to the equity market, the worst performing region was emerging market equities, with a return of minus 7.7% for the period. This was mainly because these markets were more sensitive to the weakening of global growth rates and the rising interest rate environment. The emerging economies within Europe, such as Poland, Hungary, and the Czech Republic, were among the largest negative performers over the period. This is due to the continued war in Ukraine, which has exacerbated the energy crisis, particularly in European countries, which are more reliant on Russian gas supply. The impact of this also fed into the European equity performance as a whole. The most resilient equity market over the period was Japan, which produced a negative return of minus 1.2%. This relative outperformance compared to other equity markets was due to the fact that the Japanese consumer appeared more resilient and that company results were also more favourable than expected. Within the fixed income market, the quarter produced another period of double-digit negative returns. There was also a record level of volatility in gilt yields towards the end of the quarter, with the 20-year yield reaching an intraday high of over 5%. This was driven by political and economic developments within the UK. Looking at equity markets specifically, we can see that although the global and UK equity markets delivered negative returns for the quarter, these returns were not as pronounced as in Q2. At the beginning of the third quarter, equity markets rebounded slightly before continuing their downward trend. This shift was primarily driven by the global economic outlook weakening, monetary policies tightening, and the persistent level of inflation. On a global basis, some of the key drivers of performance were the ongoing energy crisis in Europe, as the war in Ukraine continued and the Nord Stream pipeline was shut down. The US Federal Reserve also became more hawkish than markets expected, which fed through into global economic expectations. Finally, China's persistence of a zero COVID policy and growing tensions with Taiwan also negatively impacted global growth forecasts. UK equities outperformed the global equity market during the quarter, as large capitalisation, consumer staples and energy companies performed well. In contrast to this, a number of sectors within the UK equity market, such as retail and travel, detracted from performance over the quarter, contributing to the negative return. These were generally related to concerns around consumer discretionary spending in the wake of rising energy bills and a 12-month CPI growth rate which rose to over 10% in July. This graph illustrates the change in index-linked gilts over the quarter. In this, we can see the significant movement in yields which occurred, particularly towards the end of the quarter. From the beginning of the quarter to September, gilt yields rose on the back of increasing level of inflation within the UK and the 50 basis point interest rate rise in July. Following this, we saw the significant move in September, with the over 5-year index-linked gilt yield becoming positive and the over 15-year gilt yield reaching 5% on an intraday basis. This move began following the appointment of Liz Truss as Prime Minister on September the 6th, whose policy was centred around promoting growth. The statement from the then UK Chancellor, Kwasi Kwarteng, came on 23rd of September, where he announced numerous unbudgeted tax cuts in an effort to stimulate growth amid the rising cost of living. The consequence of this, however, was that it brought into question the credibility of the UK's fiscal and monetary policies, as UK inflation remained high and the strength of the UK consumer was weakening. The consequence of this event was a significant weakening of sterling and the spike in yields. As a result of this rapid move in yields, the Bank of England stepped in as a purchaser of long-dated gilts on 28th of September, which caused yields to fall back. Following the end of the quarter, there has been more stability in gilt yields as both the UK Prime Minister and Chancellor were replaced. We will now provide a brief overview of the UK economy. This graph shows the GDP growth rate for each quarter from the second quarter of 2006. In the third quarter of 2022, UK GDP is estimated to have fallen by 0.2% based on the first estimate. In output terms, there was no growth from the services sector over the period, as growth in the education sector was offset by the slowdown in wholesale and retail trade. This was largely the result of the rising cost of living and the impact this has on disposable incomes. Looking at the UK's manufacturing output, this also fell during the quarter, which makes this the fifth quarter of negative growth for this sector. The sector contracted by 2.3% over the period, with the largest negative contribution coming from the manufacture of basic metals and metal products. Some companies indicated that this was due to a shortage of supplies, while others indicated that supply concerns were easing. Within construction, the output rose by 0.6% in the third quarter. This was largely driven by increases in new work orders. However, construction firms have indicated that they continue to face challenges in the current economic environment due to labour shortages and price pressures. The next slide shows longer-term UK economic growth in greater detail. From the end of September, GDP increased by 1.3%, but is now below the pre-COVID-19 level following the contraction this quarter. GDP is estimated to have increased in July, but decreased in August by 0.1% and September by 0.6%. This may have been impacted in part by some businesses closing during the September bank holiday for the state funeral of Her Royal Majesty Queen Elizabeth II. The graph also shows the changes in output for the services, construction and production sectors. As the UK is predominantly a service-based economy, the movements in service outputs largely mirror those of the total gross domestic product. As we can see, there was a sharp fall in output during the COVID pandemic, which negatively affected all sectors, particularly construction companies and consumer-facing service companies. Moving to the most recent period, the outputs from both the production and construction sectors have recovered to above their January 2020 levels. The level of production output has, however, been decreasing, as supply chains have become constrained due to the impact of the war in Ukraine and China's zero-COVID policy. Looking at the services sector, its output has recovered to around the January 2020 levels before beginning to decline in August and September. This was mainly due to a reduction in wholesale and retail trade over the third quarter and information technology output over September. The next slide analyses the change in the UK unemployment since January 2016. As we can see in the graph, the unemployment rate steadily declined from 2016 until the start of the COVID pandemic, when the UK unemployment rate increased. This occurred in spite of the government's furlough scheme and as a consequence of the UK COVID restrictions that were put in place. However, over the past year or so, the unemployment rate has recovered and even moved below the pre-pandemic levels. This shows the recovery of the UK following the coronavirus pandemic and also reflects the fact that a number of working age people removed themselves entirely from the labour force. A consequence of this, however, was that it increased the level of demand while supply chains remained constrained, which caused the level of inflation to rise. Looking at the most recent quarter, the unemployment rate has begun to increase, moving from a low of 3.5% in July to 3.7%. This was a consequence of the contracting economy. The number of job vacancies in July to September 2022 was 1,246,000. This was a decrease of 46,000 from April to June 2022. Growth in average total pay, including bonuses, was 6% in July to September 2022, but fell in real terms by 2.6% on the year. This remains one of the largest falls in growth since comparable records began in 2001. We will now briefly discuss some notable matters that occurred during the third quarter of 2022. Inflation remained a key risk factor over the third quarter. The 12-month Consumer Prices Index, or CPI, which is a measure of inflation, reached a high of 10.1% in July and September 2022. This is over 5 times the Bank of England's 2% inflation target, and the main contribution to this rise was a rise in food prices. In an effort to curb the elevated level of inflation, the Bank of England raised its base rate twice over the quarter by 50 basis points, bringing the rate at the end of the period to 2.25%. Liz Truss was appointed as the new UK Prime Minister following her successful campaign on 6 September. She then announced her agenda, which was centred around increasing economic growth and combating the cost of living crisis. On the 23rd of September, the UK Chancellor then provided a mini-budget announcement which consisted of numerous unbudgeted tax cuts and increased fiscal spending. This announcement caused long-dated gilt yields to rise, with the 20-year gilt yield reaching a high of over 5% on the 28th of September. The value of the sterling also fell, reaching a low of less than $1.035 to the pound. Following the announcement of the UK Chancellor, the Bank of England stepped in to buy long-dated gilts and provide stability to markets. This caused the gilt market to recover towards the end of the quarter. The key driver of the current economic environment is the fact that supply chains remain constrained. This is due in part from the war in Ukraine, but is also due to the continuation of China's COVID lockdown policies and the persistently high level of demand. These factors have contributed to the inflationary concerns mentioned previously and indicate the likelihood of a stagflationary recession in the coming quarters. We will now discuss the outlook of the short and medium term. This slide shows the International Monetary Fund's growth forecast for the year ahead. The IMF have forecasted that global growth is expected to slow from 6% in 2021 to 3.2% in 2022, consistent with their previous forecast. They did, however, revise their forecast for 2023 down by 0.2% to 2.7%, with a 25% probability of it falling below this level. Within these forecasts, IMF are predicting that more than a third of the global economy will contract this year or next, and that for many people, 2023 will feel like a recession. These forecasts were made in the context of the many turbulent challenges which face the global economy, such as the high level of inflation, tightening of financial conditions, Russia's invasion of Ukraine, and the lingering impact of the COVID-19 pandemic, particularly in China. Moving on to the next slide, inflation will remain a key risk factor in the coming periods. As already discussed, CPI reached a high of over 10% during the quarter. As a result of this, markets are expecting central banks to continue to tighten monetary policy in order to combat the level of inflation. In the UK, there is a high level of uncertainty around what this rate path will look like, with some participants expecting between 4 to 5% in 2023. Tighter monetary policy will inevitably impact economic growth, which has already been trending downwards. In addition to this, governments are less able to provide fiscal support in the contracting economic environment, as this may make it more difficult to reduce the level of inflation. As evident from the current environment, the economic outlook includes significant risks, with many countries wrestling against the possibility of a stagflationary recession. These factors represent significant short to medium term headwinds, which we will continue to monitor in the coming quarters. Moving to our outlook as at November 2022, Quantum are relatively neutral on developed equities, as they can provide strong returns and a good hedge against inflation, but the short to medium term headwinds should not be overlooked. We also believe that stock selection is key given the stagflationary and geopolitical risks, favouring companies with more resilient pricing power and strong supply chains. We are also neutral on emerging market equities. Emerging market economies have the potential to benefit from post-COVID-19 recovery, but the headwinds already highlighted could impact this. Within emerging markets, we think that regional selection will be particularly important, whereby regions that are less exposed to the war in Ukraine and inflationary pressures will be better positioned for the future. With regards to UK government bonds, we have a positive outlook, as yields have risen significantly over the period. As a result of this, gilts look attractively priced at their current levels. In addition, gilts remain a good hedge for pension scheme liability risks. It is important to note, however, that downside risks remain. This is especially true given the uncertainty over the level of inflation and the Bank of England's monetary policy. We also have a positive outlook on corporate bonds. Despite the headwinds at present, we think that short-dated credit investments remain compelling and have the potential for outperformance relative to their government counterparts. Furthermore, we have a positive outlook on private markets, which remain an attractive alternative asset class. Private credit can provide an effective hedge against inflation and offers a senior position in the capital structure, with a high level of income which is less volatile. In addition to this, there are also opportunities within infrastructure and private equity. However, it is still important to note that liquidity risks remain a key consideration for investors needing to meet cash flow requirements. Thank you for listening to Quantum Advisory's quarterly investment vodcast. We hope this edition has been informative and provided you with an adequate update on the current economic climate. If you would like to discuss any of the topics raised in more detail, then please get in touch with your Quantum contact. Once again, thank you for listening and goodbye for now.